Welcome to Iron Financial. We're the place you come to forge a stronger portfolio because we stress test the market's biggest stories. Today, we are putting HF Foods Group, ticker HFFG, right under the microscope. Now, this is a company that's in the thick of a massive, messy overhaul, and honestly, the market has no idea what to make of it. Is it building a fortress of value, or is it just digging its own grave? We are here to cut through all that noise, find the steel, and give you the unvarnished truth. Let's get to work. Okay, so let's just get right to the heart of it because this is the billion-dollar question, literally. On the one hand, you've got this colossal top-line revenue number, $1.23 billion. I mean, think about that. This is not some little startup. HF Foods is the single largest distributor for the Asian food market in the entire United States, which, by the way, is a $50 billion industry. So they're a giant in a giant market. But on the other hand, the stock is trading for less than a gallon of gas. I mean, it's just mind-boggling. That huge gap, that massive chasm between the revenue they generate and the value the market gives them, that's a screaming signal. And it can only mean one of two things. Either it's a massive, colossal market mispricing, a deep value gem just waiting to be polished, or it's a giant, flashing red flag telling you to stay away. Our entire job today is to figure out which one it is.
Exactly. So what are we really looking at here? Let's frame this up. Possibility number one. Is this a company with a framework of solid steel just covered up by the dust and noise of a big renovation? You know, a hidden gem the market's too lazy or too scared to look at closely? Or is it possibility number two? Is this a value trap? Does it look impressive from the highway, but when you get up close, you see the foundation is crumbling, the support beams are rusted out, and it's all just hidden behind a cheap coat of paint from management? Look, the stakes for you, the investor, could not be higher. Getting this call right is the difference between finding a stock that could multiply your money and walking straight into a portfolio write-down. It's that serious. To even begin to understand this, we have to start with management's side of the story. You got to listen to their pitch. See, any company going through a big turnaround, they have a blueprint. It's the plan they show to investors to say, hey, stick with us. We know it's painful now, but it's going to be worth it. HF Foods is no different, and their claim is a big one. They say they're not just patching a few holes in the roof. No, they claim they are tearing this whole business down to the studs and rebuilding it from scratch on a much, much stronger foundation. This is the bull case. This is the optimistic story coming straight from the top. And here it is, from the CEO, Felix Lin. Let's really break down the corporate speak here, because every word is chosen carefully. He says, comprehensive transformation plan. That's meant to sound strategic and all-encompassing. Then he says, the foundation now largely in place. Now that is the key phrase. What he's trying to tell the market, what he's signaling, is that the really hard part, the expensive, dirty, heavy lifting, is basically over. He wants you to believe they're moving from a phase of spending money to a phase of making money. It's a classic story. We've poured the concrete, we've laid the rebar, and now we're ready to build up. It's a nice, forward-looking statement designed to make investors feel safe. But here at Iron Financial, we don't trust blueprints. We test them. So what's actually in this blueprint? What are the tangible steps behind the CEO's nice-sounding words? Well, here they are. First, a digital overhaul. They've rolled out a full enterprise resource planning system, an ERP. Now, for a modern distribution company, this is everything. It's the central nervous system. It connects inventory, sales, logistics, all of it. It's a huge, painful, and very expensive project, but you absolutely need it if you want to be efficient at scale. Second, they consolidated their sales operation, merging 2 call centers into one. That's a classic business school move to cut costs and standardize how you sell. And third, they're upgrading their actual buildings, their physical footprint in key hubs like Atlanta, Charlotte, and Chicago. This is about being able to handle more business and grow. So you look at this on paper, and yeah, it looks like a solid, logical plan. It makes sense.
All right, that all sounds great. It's a really compelling story. Modernization, efficiency, strategic investments. Who wouldn't like that? But here's the thing about us at Iron Financial. We don't invest in stories. We invest in strength. And the only way to measure strength is with cold, hard numbers. A pretty blueprint is totally worthless if the concrete is weak and the steel is flawed. So now it's time to put on our hard hats, get past the fancy talk, and go inspect the financial structure of this company ourselves. We need to see if the numbers on the income statement and the balance sheet can actually support this grand vision they're trying to sell us. Okay, let's do it. Let's forge right into the financials, because this is where the truth lives. We're going to start with the big, ugly headline number, the one that's calculated according to GAAP, which is just the official accounting rulebook. It's the number that grabs all the headlines, and to be honest, it looks absolutely terrifying. We have to start here, though.
We need to understand exactly what's scaring the market so badly before we can dig deeper and see if there's any real strength underneath. Consider this the first stress test.
And there it is, a net loss, according to the official rules, of almost $39 million. Now, let's put that in perspective. For a company whose entire market value is hovering around $100 million, a number like this isn't just a loss, it's a wrecking ball. This is the kind of number that makes professional and retail investors alike hit the sell button without a second thought. On the surface, it just looks like a total catastrophic failure. It looks like the whole business is fundamentally broken and burning cash at a rate that's just not sustainable. And you know what? If you stopped your analysis right here, you'd walk away thinking this is a no-brainer value trap. But the most important thing I can tell you is you can't stop here.
So the obvious question is, what on earth is causing that giant, scary number? I mean, did the company actually light a bonfire with $40 million in cash last year? No. The answer is no. The real culprit here isn't a business problem. It's an accounting entry. A massive, one-time, non-cash charge is twisting the whole picture and making it look way worse than it is. To get to the real truth of this company's health, we have to find that charge, pull it out, and see what the business actually looks like without it. This is a critical step that, frankly, most of the market is too lazy to do.
The charge is called a goodwill impairment. Now, let's make this simple. When Company A buys Company B, they often pay more than all the buildings and trucks are actually worth. That extra amount you pay for things like brand name or customer lists gets put on the books as an asset called goodwill. But if later on you decide that brand name isn't worth as much as you thought, the accounting rules say you have to impair it. You have to write it down. The key thing to understand, the only thing that matters, is that this is a non-cash charge. No money actually leaves the company's bank account. It's literally an accountant just erasing a number on a spreadsheet. It demolishes your net income on paper, but has zero effect on your daily operations or the cash you have to run the business. And here's the kicker. HF Foods has now written their goodwill all the way down to zero. This particular wrecking ball can never, ever hit them again. And this table, which comes straight from their earnings report, shows you exactly how they do the math to flip the whole story. See, you start at the top with that ugly net loss of $38.8 million. Then, look at this line. They add back the entire goodwill impairment of $38.8 million. They also add back a bunch of other non-cash or one-time expenses, like almost $16 million in amortization and about $3.6 million for those transformation costs we talked about. So you take the bad official number and you add back all the accounting quirks and one-time stuff, and the picture at the very bottom changes completely. And boom, there you have it. You go from a nearly $39 million loss to an adjusted net income of positive $16.9 million. And it gets even better. Not only is it a positive number, it's up almost 21% from the year before. This right here is the steel frame of the bull case. This is the argument. It suggests that if you can just ignore all the accounting noise and the mess from the turnaround, there is a profitable and a growing core business underneath it all. This is the number management wants you to focus on. They're arguing that this number, the adjusted number, shows the real earning power of the company. And you have to admit, it's a very powerful argument.
Whoa, hold on a second. That's a very neat, very tidy story you just told. You just strip out all the bad stuff and presto, everything looks fantastic. But you know what? It feels a little too neat, a little too convenient. A truly strong structure, a solid foundation, has to be able to withstand pressure from every direction, not just look good from one specific angle. I'm not sold that this foundation is as solid as that one adjusted number makes it seem. It's time we apply some real pressure. Let's look at the most recent trends and start looking for the cracks in this armor. Let's see if this shiny bull case can handle a real stress test.
And we can start right here. See, the bull case loves to point to this number on the left. Full-year adjusted EBITDA growth of almost 7%. Looks pretty solid, right? But that's the whole year. What happens if we zoom in on just the most recent, most relevant quarter, Q4? Well, adjusted EBITDA didn't just slow down a little bit. It fell off a cliff. It dropped by a jaw-dropping 33.7%. This isn't a small crack. This is a sinkhole opening up. This tells me that whatever positive momentum they had earlier in the year has slammed into reverse. A strong building doesn't just have one of its main support columns weakened by the third in 3 months. This suggests those headwinds management talks about aren't just a light breeze. They're becoming a hurricane.
And here's another crack that's been there for a while. Their margins are getting squeezed. So while the revenue went up a little, their gross margin, the profit they make on every single thing they sell, actually went down from 17.1% to 16.9%. Now, that might not sound like a huge drop, but in a business like food distribution, where margins are already razor thin, every little bit counts. It means that for every dollar of stuff they sell, they're actually making less money than they did a year ago. Higher costs are eating their lunch. A healthy company that's getting bigger and more efficient should be expanding its margins, not watching them slowly bleed out. This is a sign of fundamental weakness. So let's just lay out all the warning signs on the table. We've got the margin pressure we just talked about, plus their operating expenses are going up. Their debt-to-equity ratio is almost 1-to-1, meaning they have nearly as much debt as their company is worth. That's a heavy load to carry. Their current ratio, a measure of their ability to pay short-term bills, is 1.19, which doesn't give them a lot of wiggle room. But the real flashing red light on this whole dashboard is this last one, the Altman Z-score. It's a formula that financial analysts have used for decades to predict the odds of a company going bankrupt. At 1.29, HF Foods is squarely in what's called the distress zone. Any score below 1.8 signals a high risk of bankruptcy in the next 2 years. This isn't just a hairline crack. This is a seismic vulnerability in the company's entire financial foundation. So, after all that, what does the market think? You don't need us to tell you. Just look at this stock chart. Forget the bull story, forget the bear story, just look at what actual investors buying and selling with real money are doing. This is not the chart of a stable company with a predictable future. It's a heart attack on a screen. It's wildly volatile, the price explodes higher on any good news and then gets absolutely crushed on any bad news. This chart is a perfect picture of deep, profound uncertainty. It's telling you that the market is hearing management's story, but it's also seeing all the cracks we just pointed out and has absolutely no conviction about whether this building is going to stand or fall. The stock's behavior itself is a huge red flag. Okay, we've laid out the blueprint from management, and we've made the case for a solid steel core hidden underneath all the mess. But we've also taken a sledgehammer to that structure and found some very significant cracks and major warning signs. So where does that leave us? Where does that leave you? It's time to weigh all the evidence, put the bull case and the bear case on the scales, and come to a final actionable verdict. Is HF Foods a high-strength opportunity, or is it a high-risk trap? Let's summarize the final battle. The bull case, the foundation, is built on undeniable scale. We're talking over $1 billion in revenue. It's profitable when you look at it the right way, and that profit is actually growing. The transformation they're doing is real and it's happening, and the valuation is just dirt cheap, trading at a price to sales of just 0.1. That's insane. But the bear case, the cracks, are just as powerful and just as real. You cannot ignore that 34% drop in Q4 profitability. You can't ignore the fact that their margins are getting squeezed, and you absolutely cannot ignore an Altman Z-score that is screaming distress. The stock chart shows the market has zero confidence, and the debt is a real concern. This is a classic unstoppable force meeting an immovable object. So, our final verdict starts with this. And let's be absolutely clear. This is not a safe, stable, blue-chip stock. This is a construction site. It's messy, it's noisy, and it's dangerous. It's a high-risk build that is currently in progress. Now that means there is potential for a huge reward if they finish the project and it's beautiful. But there is also a very, very real risk of a catastrophic failure along the way. Anyone even thinking about this company has to understand, you are not buying a finished house. You're buying a plot of land with some rebar sticking out of it. To put it in our terms, the foundation is being poured. All that stuff, the ERP system, the facility upgrades, the new call center, that's the concrete and steel. And honestly, it looks promising. Yeah, but the problem is, the structure is nowhere near complete, and they're trying to build it in the middle of a financial hurricane. Those headwinds, all the cost pressures, the margin compression, that shaky balance sheet, those are real, and they are significant. The big question, the only question that matters, is whether the foundation they've poured is strong enough to let them finish the building before that storm causes the whole thing to collapse. So this brings us to the most crucial point. Who should even be looking at a stock like this? This is not for a conservative investor. This is not for someone saving for retirement who wants a move-in ready financial fortress to protect their capital. This investment is exclusively for speculators. It is for people with a very, very high tolerance for risk, who have done their own extensive research, and who can mentally and, more importantly, financially handle a situation where this stock goes to zero, because that is a real possibility. Now, if the turnaround works and the market decides to revalue this company, the upside could be huge. But if those cracks we found today widen into structural failure, the downside is a 100% loss. So the final question isn't really about HFFG's foundation. The final question you need to ask is this. Is your portfolio's foundation strong enough to take the hit if this one collapses?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.